climate change at the end of the day, it's an economic problem. It's about how do we produce goods and resources and services without this unfortunate byproduct, these greenhouse gas emissions that come with it. And so if you look at it through an economic or business or sort of financial lens, we start to do the math and think about the numbers and so on, a couple of things come to light. First of all, you start to make it much more objective than emotional. And I think that's really important. Secondly, you start to understand what the problem is. You can frame the problem. You can also start to frame and understand the solutions. What's going to cost us? How do we reduce those costs? How do we deal with it?
Hi, folks. I'm absolutely delighted to welcome today's guest, Bruce Usher, who's at the forefront of an incredibly important development in business and investing, namely the race to invest trillions of dollars in order to shift the global economy toward a low-carbon future that mitigates the risks of climate change. Bruce is the author of an excellent book titled Investing in the Era of Climate Change, which I have here. He's also been an entrepreneur and a successful CEO and an active investor in early stage companies and a very renowned professor at Columbia Business School. Thanks so much for joining us, Bruce. Welcome.
Thank you, Elliot. Pleasure to be here.
Great. Part of your mission as an author and as a professor is really to raise awareness among investors that we've entered a new investment era and that there's an extraordinary and possibly once in a lifetime opportunity to invest in a wave of innovative climate change solutions, including things like solar energy and wind energy and electric vehicles and the like. In your recent book, you wrote that this is the greatest reinvention of the global economy since the Industrial Revolution. And you also mentioned that the transition to a global low-carbon future has begun, providing investors in the era of climate change with the opportunity and challenge of a lifetime. Can you talk about the scale of this economic challenge and the investment opportunity that it's creating?
Sure. So let me begin with the big picture, right? The big picture is since the Industrial Revolution and the agricultural revolution that followed it, William, we've spent 300 years building a global economy, mostly a market-based economy, that by many measures is extraordinarily successful. The average human being today is 50 times as well off in real terms than they were pre-industrial revolution. We have food production, we have transportation, we have housing, we have things that were unimaginable not that long ago. But there's a catch, right? And the catch is that global economy emits massive amounts of greenhouse gases. And we know very well at this point that is truly unsustainable. We will keep doing that, and that will be the end of the global economy and more. So after 300 years of building this, what I think is a pretty incredible thing we created as humans, we have about 30 years to entirely rebuild our global economy so that it still produces a level of prosperity, ideally for all, but does not emit greenhouse gas emissions. And what the climate scientists tell us, and I have a lot of trust in that science. I've looked at it closely and I've followed it for a long time, is that we need to reduce our emissions, not just a little, not just a lot. We actually need to reduce our emissions essentially to zero, or what they call net zero. So this is going to require a massive, literally rebuilding of the economy. When I say rebuilding, it's not a piece of software. It's going to solve this problem for us, or an app that's going to solve this problem for us. It's literally mostly physical infrastructure, because most of the things that emit greenhouse gases, whether it's production of electricity or transportation, cars and airplanes, buildings emit greenhouse gases, our agriculture emits greenhouse gases. These are physical things. And these physical things are going to change. And that creates both an enormous challenge to do this in a short period of time, but also an enormous opportunity from both a business and investment perspective. It is going to take trillions of dollars to reinvest and to rebuild that economy.
And I think you quote at one point a number from Boston Consulting Group from 2021, where they said $150 to $200 trillion of investment is needed in the coming 3 decades to protect the planet through financing the decarbonization transition. So in a sense, this is terrible news for the planet, the scale of the challenge. But for investors, it's actually, there's kind of an alluring capitalistic case that this is an enormous opportunity.
Absolutely. And like, first of all, like any great change, this is going to create opportunity. It's also going to create, companies, investors who are going to do very poorly, or in some cases, companies are going to go away. So this change is going to be very disruptive, right? An analogy to that is the change that we've seen with the digital revolution in the last couple of decades. And let's take it from 300 years down to like the last 30 years. And if sort of think about the last 30 years, roughly the time since I graduated from business school to where we are today, and I'm dating myself here, William, we've seen the global economy change dramatically because of digital technologies. Right? There's not a single business in the world today that's not affected in some way by digital technologies. And that's created a lot of new winners in business and investment and a lot of firms that have stopped from going out of business. And there was a wave of investment behind that, which continues to this day, including things like AI. That's not going away. What we're going to see now in the next 30 years or so is another massive wave of investment into the decarbonization of the global economy. The number you quoted is BCG number. I don't know if that number is right or wrong. Nobody knows for sure. I think it's a pretty decent guess. It's a huge number, but it's also important to put it in context. It's also a doable number. In other words, if we sort of, in my book, I look at how much capital is there available in the capital markets, the fixed income markets, equity markets, and so on, venture capital alike. And that capital exists, and a lot of it, actually close to half of it that we need, is already moving in this direction. With a caveat, and the caveat being that investment in low carbon solutions in developing country or emerging economies is really lacking, and there's no clear path to how that's going to change anytime soon. That's a whole special challenge. But big picture, a lot of capital needs to move. A lot of capital already is moving, and the capital is available.
You mentioned in the book that there are 5 major trends that are driving this very rapid and sustainable flow of capital into climate solutions. And we'll talk very specifically about some of those climate solutions, whether it's renewables or electric cars or whatever later. But I really wanted to talk in some depth about these trends because I think it's very clarifying. It makes it really clear for our listeners why this is such a profound shift. And so the first trend is the manifestation of physical risks. Can you talk us through that? Because obviously we've just lived through, I think, the hottest summer in recorded human history, and we've seen many of these extreme weather events lately, whether it's wildfires in California or Canada or heat waves in Oregon or India or wherever, and flooding in Florida and record-breaking hurricanes and the like. My impression from you is that something has shifted and people are starting to become really aware of it.
That's right. So one of the challenges in addressing climate change, it's always been a problem of the future, right? Scientists telling us, if we keep going this way, it's going to be a very serious problem, a potential catastrophe. And look, it's hard to take action, particularly, really challenging changes and big investments for something that's so far in the future. And frankly, something that until very recently, none of us experienced. You couldn't see or taste or feel climate change. And so that kind of risk is a really hard one to deal with. We're not good as humans at dealing with that kind of risk. And what has changed very recently is, as I wrote, is a physical manifestation of this risk. In other words, we're starting to experience climate change. Now, this is not a good thing. This is a very bad thing. But there's a silver lining. The silver lining is getting people's attention, and they're starting to realize that this thing that was talked about that would be years or decades in the future is happening today and is almost certain to get worse. So it's getting people's attention, and that is starting to change things. That's the first of the big trends I identify.
I was very struck by a quote in one of your talks or in the book, perhaps, from the World Bank report in 2022, where they warned that India could become one of the first places in the world to experience heat waves that break the human survivability limit. But then you're also talking about these issues much closer to home, like with flooding in places like Florida or wildfires in California. And you quoted somewhere Zillow, the real estate company, estimating that I think 800,000 US homes worth something like $451 billion are at risk of flood inundation by 2050. Can you talk a little bit about how before we get to the next of these 5 trends, how we actually in practical terms can protect ourselves from this very real sense that there's an actual pragmatic and urgent risk to things like our property.
Yeah. So first of all, let's put things in context here, right? It's I do not believe or agree with those who predict this is existential crisis. It's the end of humanity. We're all going to die. We're but it's a hopeless situation. What some people refer to climate defeatism. We're done for as a species. Humans are incredibly adaptable. We're incredibly innovative, and we're very good at dealing with challenges when we set our minds to it. So the World Bank report for India is very worrisome because when temperatures get above a certain level, particularly combined with humidity, what they call wet bulb temperature, the human body can no longer sweat, and you will die. In fact, in those circumstances. Now, of course, in many economies, we have air conditioning. That's what keeps us alive when it's that hot and humid. And, we have places to stay cool and our ability to do that. So the question is, how does one think about this in an economy like the US or much of the world, these changes that are coming? How are we going to adjust those? What does it mean? What it means is that these physical changes are hitting us now, and they're just going to keep getting worse until we decarbonize. That's the first thing to understand. The second thing to understand is we will, to a certain extent, adapt to those. We will use more air conditioning. We will be moving people away from coasts where there's constant flooding and the like. We will have to fight more wildfires. I mean, what happened in Canada this summer was pretty interesting. It was 10 times as much wildfire as they've ever experienced before. In a place like New York City here, we got, inundated with smoke, which is not just annoying, but actually very bad for your health and so on and so on. So we're going to see a lot more of that. We're going to be dealing a lot more with that. And from a financial or investment or business perspective, we're going to see that we will have to invest in it and adjust this. And this is whether or not you quote unquote, believe in the climate science, the science of climate change, excuse me. It's sort of irrelevant. I don't believe in gravity or not believe in gravity. It's physics. It's basic physics. And climate change is also basic physics. You're basically forcing more energy from the atmosphere to remain on Earth as opposed to being reflected back into space. So you can believe in physics, not believe in physics. Not relevant to this discussion. What's relevant is these changes are happening, and there's going to be, as a result of that, we will have to invest differently in the future.
You mentioned somewhere in your book that it's worth avoiding a Minsky moment where suddenly an asset class is totally repriced, as happened with something like subprime bonds in 2008, and that there can be these sudden kind of collapses where it becomes really difficult, for example, to get insurance for certain types of property in areas that are very at risk of flooding. And I was interested that one of your practical pieces of advice was, look, it's better to act early than late. And so it's smart to trade out of assets facing climate risk. When you look at the immediacy of some of these extreme weather effects, does it make you think there are certain places you just want to sell your property? It's not a smart place to be?
Yeah, basically, yes. Or at least be diversified around it. In other words, having all your assets in a basket that is exposed to, perennial flooding, chronic flooding, or potentially disastrous storms isn't too smart. Now, it's not just the greatest risks are not necessarily the physical ones. And when people think about climate change and risk, they're thinking about, physical risk to their assets. But in fact, a lot of that risk is what we call transition risk as markets change and as business changes. And what's happening in insurance is a good example of that. So just because you say, well, I'll take the risk of a storm coming, I can deal with the rising cost of this. At some point, your insurance rate starts to go up. Now, insurance in this country, particularly flood insurance, the market's a bit, it's affected by government action. It's not really a proper free market, but eventually insurance rates go up, or even worse, you cannot get insurance. Now, if you can't get insurance on your home, you can't get a mortgage on your home. If you can't get a mortgage on your home, good luck selling your home. And by the way, the community that you live in, if you're not the only one, and it's highly unlikely it's just one home, it's going to be whole communities, that community's tax base starts to collapse. And when the tax base collapses, goodbye to the good school system and the healthcare and so on. So what you see is the transition risk associated with climate change is actually the one that you really need to think about. What's going to change through this in the next couple of decades as we deal with climate change and decarbonize? And what does that mean for me and my assets? That's really the concern.
Yeah, and I think the underlying theme of this discussion is we're not trying to be fear-mongering. We're just trying to give people better information because there's so much misinformation in this area. So once you can think a little more clearly about this, you can start to say, okay, this train is coming, whether I like it or not. And I would be smarter to be aware of the things that are going to happen so that I can plan accordingly.
Exactly. And I think that's the most important thing here. By the way, at the end of the day, and I know people read my book who come back to me and said, wow, you're an optimist about climate change. I'm not an optimist. I'm not a pessimist either. I'm a realist. And what we see is this pretty massive challenge. It's a very serious challenge, and it's a complex challenge. But I think we'll discuss this in a few minutes. We also have the capital and most of the technologies we need to address the challenge. And I'm pretty optimistic about it. I'm much more optimistic than I was a decade or two ago when I began working in this area, because we've made a lot of really tremendous advancements. So it's not a question of fear mongering for sure. I don't think that's helpful, by the way, or being optimist pessimist. I think it's just about understanding where are we and where we're headed. And to your point, there's unbelievable misunderstanding out there. I think the media tends to report extreme situations. That's what gets people's attention. I think politicians don't help because they tend to make misleading statements. And so, I really want to get people to understand what's going on.
Yeah, I appreciate it. Your goal here is to clarify, not to terrify.
Exactly.
So getting to trend number 2, the second of our big 5 trends that are driving this tremendous wave of capital into climate change solutions. This is technological innovation. You've been in this field as a executive, a CEO, an investor, and the like, really since I think about 2002.
Right.
Can you give us a sense of what's changed from those early days in terms of technology when this stuff didn't really seem to be that competitive or viable or scalable?
Yeah, the change. Honestly, it's unbelievable what has happened. That a little more than 2 decades have been involved in this. Let me give you some data to bring that to light. So the first is, when I got on this field, we had solar power. It existed, some wind power. But if you added up all the solar panels in the world, you collected them all together, and you said how much electricity they generate, it was equivalent to the one coal-fired plant. Nothing. Fast forward and the reason why it was very expensive, and there was no scale. Fast forward to today, we'll construct in this year globally, when I say we, globally, somewhere between 200 to 300 coal plants worth of solar will be built. In other words, we're going to replace hundreds of coal-fired facilities this year in solar alone, without even getting to other renewable technologies. Why? Because today it is the cheapest form of new power generation in much of the world. It's not just good for the environment. It's just a great product. It's the cheapest product to produce electricity. Now, it has challenges around intermittency and other issues, but it's an incredible change. There's a product that's come down since it was first used a couple decades ago. It's declined more than 99% in cost. Then there's electric vehicles. And I got into this field a couple decades ago. There were no electric vehicles, right? Golf carts. Nothing that was practical. Today, the entire automobile industry is going electric. And why is that? Well, it's good for the environment. It's good for climate. But the main reason people drive EVs is because it's a better vehicle. It's more fun to drive. It accelerates faster. It handles better. And over the lifetime, the running costs are much, much lower. So we're coming out with these better products that literally 20 years ago didn't exist or were just completely uncompetitive. That's the innovation that's happened in the last 20 years. And that's the big stuff. And we actually take just those two categories: renewable energy, wind, solar, electric vehicles, and energy storage, which is essentially mostly lithium-ion batteries. If we just take that and we scaled all that globally, by the way, it is scaling globally at this point, but if we go 100% on all that, which we will, that will reduce global greenhouse gas emissions by about 50%. That alone takes us about halfway to addressing this problem, which is amazing. And then when we talk about innovation, the other half, we don't have scalable solutions yet, but we've got thousands of technologies and thousands of business models under development and company innovation to get to the other half. And I can't tell you with certainty which of those technologies will succeed. I think there's some pretty interesting ones out there that I've been looking at. But I have some confidence that those technologies will also be developed, just as we saw solar and others in the last couple of decades. So to me, the biggest trend, the most important one, I should say, is this trend in innovation. What we now have the ability to decarbonize global economy, which when I got this 20 years ago, sure, we had more time to address climate change back then, and time is our big challenge here. But we actually didn't have the solutions we have today, and that's a fundamental difference.
And my sense is that the kind of hierarchy of technologies in terms of their impact and importance is probably renewables like solar and wind power, electric vehicles led by companies like Tesla and BYD, energy storage, maybe a little further down the road, green hydrogen and carbon removal.
That's right.
So that's sort of the heart of it.
Yeah, because that gets to most of your decarbonization. That gets you the majority of the way that we need to get to. But I would sort of break those into two groups. And the first group being renewables, electric vehicles, and storage. Those industries are already competitive with the incumbent products, the fossil fuels or other polluting products that are out there, and they're already at scale. All right, these are multi-$100-billion industries already. So it's not a question of, is this stuff going to work? It's just a question of how fast can we get to 100% with those technologies. And based on the current, how fast those sectors are growing, I think in the next, well within the 20 to 30 years we have, those sectors will be 100% renewable pretty much, or very close to it. 100% electric vehicle on automobiles, not necessarily on heavy trucks. Then the other group of technologies, you mentioned green hydrogen, carbon capture, and there's some other technologies there. I put them in a different bucket because they're not yet competitive. You produce those technologies and it's going to cost you more than the current technologies you're trying to, the polluting technologies you've got right now. Now with government subsidies and the like, you can compete, but you can't rely on government subsidies forever. And so those technologies have got to drive down the cost curve in the next couple of decades. Otherwise, they're not gonna be there for the long term.
I was chatting to a friend of mine, Brian Lawrence, who you may know, who's a hedge fund manager at Oak Cliff Capital and a member of Yorktown Partners. And we were talking this morning about the fact that I was about to interview you. And I was saying, because he's an expert on renewable energy and coal and the like, I was like, what should I ask Bruce? And he said, look, you've got to raise the fact that all of this media coverage about the falling cost of wind and solar and how they're cheaper than coal and natural gas is fundamentally flawed. And he said, actually, on average, solar may be cheaper than a coal plant, but only between the hours of 9 a.m. and 3 p.m. And then there's this big difficulty of asking, well, who provides the power when solar isn't running? Who's going to pay for the batteries? And he also sent me a report from a guy called Michael Sembalist at JP Morgan, and I'm sure you've read, that was way above my head, that talked about the levelized cost of energy, was basically saying, look, the actual cost of wind and solar power is greater than it's presented as in public, because people aren't really taking account of things like the need for backup power or storage or reserve margins to maintain the system so it's reliable, or just the need to overbuild wind and solar capacity to meet demand in these very decarbonized systems. This is way above my head, but I feel like I need to ask you about this because, again, there is
good question. Yeah, it's a good question.
So yeah, guide us through this in a way people like me who struggle with the technology can understand.
So that concern regarding renewable energy is a valid concern, but oversimplifies the situation and it is complex. So again, let's start with the big picture. The big picture is we're going from a world of what we call centralized power generation, where big power plants, coal, natural gas, nuclear, produce electricity and push it out to the grid, to our homes, to our businesses, right? We're moving to a decentralized or distributed model where power is being produced in millions of sites, home solar panels and wind projects and so on and so forth, all over the place, and stored in many different sites, whether it's through batteries or other ways, which I'll get to in a minute. And so moving from that centralized to decentralized model adds a lot of complexity to the how we manage electricity going forward. The second point I would make is there's sort of this, and those points that are made, this idea that we're going from power sources that are perfectly stable and very easy to manage to a power source that's intermittent, which is true, and therefore, super complex and very expensive. The reality is the grid today, before there was renewable energy, it was already a very difficult thing to manage because even constant sources of power like coal and the like, they're not 100% reliable. Coal plants run something like 2/3 of the time on average. And more importantly, the demand side is never constant. It's called the load profile. Think about it. During our conversation here in the afternoon, we're using a lot of electricity. It's some parts of the country very warm, so air conditioners are on, or in winter it gets very cold, so heating goes on, or so on. We draw a lot of electricity in the afternoons. When we go to bed at night, our electricity needs drop, right? And depending on any moment, any time, our demand and our supply have to be kept in balance. This is a really tough thing to do. And so, for example, there are hundreds of what we call peaker plants all over the country. These are natural gas-fired facilities to produce electricity that spend almost the entire year turned off. We don't use them. You think, what kind of crazy asset is that? They only get used on those rare days when demand is so high, or they call it peaks. You turn on the peaker plants. So let's start from the fact that the model we got right now is not a perfect imbalance. It's so simple and so cheap to run. It's actually already a really difficult thing we're doing. And now we're adding these intermittent sources of power, wind and solar. Well, up to about 20% of power generation, this doesn't really change the storage issue at all. In other words, you can add more intermittent power to the grid and you balance it just as we do today. So up until now, it's been kind of a non-issue. It's becoming an issue because solar and wind are so cheap and attractive. In other words, it's a good problem to have, but it's a problem. So that's where I say that, this criticism is both correct. It's a problem, but it's becoming a problem because we have such a good power generation source. So now we've got this super cheap source that we can scale. And yes, the more you start to add to the grid, you start to run into some intermittency problem. I would sometimes call the duck curve problem, which is a longer conversation. But here's the interesting point. There's a lot of ways to solve that problem. It doesn't necessarily mean we got to spend trillions of dollars building a lot of batteries. And let me give you one simple, not simple, but one example. So at the same time we're growing renewable energy, we're also rapidly growing the number of electric vehicles that are on the road, right? So what's an electric vehicle? An electric vehicle is an energy storage device on wheels, right? That's essentially a large battery on wheels. Well, it turns out that energy storage device on average in America is used 48 minutes a day, 23 hours a day, plus it sits idle. And of course, while it's sitting idle, you can charge it if it needs more power, but you can also discharge it. That's called vehicle to grid. So we've got these energy storage devices that will soon be all over the country, all over the roads, that can be part of this solution to balance the grid. Now, it's not a simple thing to do, and there's certain drawbacks and complexities you need to account for in vehicle to grid, but it's just one example of how this intermittency issue, which is a real issue, is likely to get resolved. And there are a lot of other technologies coming along that will help balance it. So I think it's a valid concern. I'm not that concerned about whether or not we'll be able to take care of it going forward. Let me tell you what I am concerned about, much more than those articles, and I'm really concerned about it. Beginning of the conversation, we talked about we got to rebuild the economy. Well, turns out that building stuff, it's a technical word, stuff, but I really mean, building anything in America is really hard to do. And it's really hard to do because we do not have a building-friendly environment. The rules and regulations, whether those are federal regulations, but much more often sometimes at the state level, and local community, a county level, a city level, make it incredibly difficult to build. So a big problem with solar and wind and everything is transmission lines connecting to the grid. It's not, okay, keeping the grid in balance, intermittency, that's a challenge, but you can't even connect to the grid. That's a much bigger challenge because try to build a transmission line in the country, you'll get blocked and sued every which way. And that's my much bigger concern here is that we know what we need to do. We have the money in the products. We can't physically, when I say can't, we can't do it in a reasonable period of time. You can build a solar project in 6 months. I'm talking about a big solar project, hundreds of megawatts. You can physically do it in a matter of months. It'll take you many years to get that project permitted and connected to the grid.
I'm very curious what you make of, say, a company like Berkshire Hathaway, which has these enormous investments in renewables through Berkshire Hathaway Energy, where they're obviously doing a great deal to invest in clean power through wind and solar and the like. And then at the same time, this massive commitment to legacy energy sources like oil and gas through things like its huge stake in Occidental Petroleum or Chevron, which I know is also doing a lot of very innovative stuff to do with direct air capture technology. There's a part of me that thinks, okay, so it's clear that we have to make a really dramatic shift towards renewables. And there's a part of me that thinks, well, there's clearly a pragmatic argument that people like Buffett and Munger are tapping into, that we are still tremendously dependent on fossil fuels. And then at the same time, I see the news a few days ago that ExxonMobil announced that it's acquiring a shale giant for something like $60 billion, which again is deepening its reliance on fossil fuel production at the same time as we're all talking about shifting to cleaner energy. And I don't really know how to place this in context, how to think about the pragmatic tension between becoming cleaner and at the same time recognizing the fact that the economy is hugely dependent on these dirtier forms of energy.
So first of all, I agree. We are hugely dependent, and not dependent as in, if we just, did the right thing, we wouldn't use this anymore. No, there's very few alternatives to flying today in terms of fuels. A little bit of sustainability is fuel, that's tiny. Most automobiles still are powered by gasoline and so on. If we suddenly just stopped using fossil fuels, we'd be back in, living in caves. And even just putting aside the ethical consideration, it's just totally impractical. So what does that mean? First of all, it means, yes, we use a lot of fossil fuels and we will continue in some years ahead. The second thing is, more importantly, what should we be doing about it? And my belief in the analysis that I've done is that pressuring companies either through a moral argument, it's the wrong thing to do, or even through a financial, divestment argument, we shouldn't finance these companies. Both of those are pretty ineffective. First of all, a moral argument, companies are designed to make profit. That's the way the market works. And so trying to convince them to do the right thing, the margin helps, but it's not going to completely cause someone to abandon an industry. And the second reason is, trying to sort of turn off the capital taps to fossil fuels. It's unlikely to work because, first of all, 90% of fossil fuels in the world, the supply is controlled by nation states. So, that's not going to work. And secondly, we tried it just recently with a big experiment, a horrible experiment, which was to turn off the taps in Russia because of the war in Ukraine. So we have a real life example where after the invasion of Ukraine, the US government and the European governments have tried to essentially stop Russia from from selling oil and gas to finance the war. And, by and large, it doesn't work because this stuff's fungible and someone else buys it. And then they buy it at a discount, but they still buy it. So what does all that mean? It means that if you want to speed up the transition from fossil fuels to non-polluting, we need to create substitutes. That's what people react to. When I say substitute, it means you need to give the ultimate end user of the product another product, and ideally a better product. That's the only thing that gets oil and gas companies to stop drilling for oil, is when they see their customer base going away. And frankly, the IEA, which represents the international energy companies, really the fossil fuel companies, they do see that coming. They're predicting declining supply because they're seeing these substitutes. So, for example, electricity generation, we will start to use less natural gas in power electricity because of renewables. In transportation, we're going to start using less gasoline. We're still going to use fossil fuels for petrochemicals and other issues. And so the real impact here is not the moral impact, and it's not the capital impact. It's the product impact. I mean, Tesla, I don't have anything to say about whether Tesla's today a good investment, not a good investment, or how Elon Musk is spending his money. But I will tell you that what Tesla has done to change the arc of emissions is really incredible. And now BYD and other companies, they're certainly not alone anymore, because now people are buying electric vehicles instead of the internal combustion engine, and that's how you reduce fossil fuel reliance.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
Yeah, and I think you pointed out in the book that transportation accounts for something like 28% of US carbon dioxide emissions. So actually having a great product there, like the Tesla, that you actually want to buy, not necessarily because it's a righteous thing to do, but because it's actually a cool car, is a huge help.
Yeah. Now, I don't want to say, William, it doesn't mean that I totally disagree with the idea of divestment. Okay. In other words, if an investor feels that they do not want to invest in fossil fuel companies because their values are not aligned with that, then I say, why would you make that investment? Don't hold those stocks. Don't hold those companies. I mean, William, I don't smoke. I'm not a huge fan of smoking. It's really nice to go to bars and restaurants in New York City since they no longer allow smoking in them. I prefer that. And, I don't really want to put my money in a tobacco company. It's not me. And so I'm perfectly fine with not investing in tobacco. And there's plenty of people who feel sort of the same way about fossil fuels. Now, fossil fuels are a little bit different because even if they're divesting, they're almost certainly still using the product because they don't have a substitute yet. And again, my example is flying. If you fly on a plane today, you're certainly burning jet fuel. But that doesn't mean you have to invest in the product. And if it aligns with your values not to invest, you should go ahead and divest. But don't think by divesting, you're solving climate change, because you're not. But there's nothing wrong with doing it. I think there's good reasons for it.
Yeah, I was struck by a couple of arguments that you've made over the years. One of which, when you quoted Yale's famous investment manager, David Swensen, who said, look, direct dialogue with corporate management is the most effective means of addressing climate change risk in the portfolio. And you pointed out that, yeah, if you sell the stock, you kind of lose your ability to influence management. So it may actually be that divestment is in some ways counterproductive. But then on the other hand, you have this beautiful quote from the academic and activist Bill McKibben, who played a very key role in starting this divestment movement, who said, if it's wrong to wreck the climate, then it's wrong to profit from that wreckage. And that's a really interesting line. What do you think of that as an insight from McKibben?
Well, first of all, it's a very powerful line, right? And it's pretty hard to disagree with that line. I agree with it. And so to me, it comes back to the values point. In other words, if you feel that your values are, I don't want to be part of making the situation worse, in other words, I don't feel my money should be going in this direction, then don't do that. That's absolutely, I totally agree. And I can see why people would feel, profiting off of additional greenhouse gases. It can seem for many people is morally wrong. I support that. But divestment, I go through the book in much more detail than I've got time for here today, doesn't really make any difference in terms of reducing emissions. You're not going to reduce emissions by not investing in an oil and gas company. It can be counterproductive. As Swenson pointed out, you no longer have a vote. You can no longer talk to management. You can no longer sway management. There's some reasons to think that in fact it can work against you a little bit. I'm on the fence about that. I don't think it's a big either way. But again, it's not a climate solution. It's a values-based decision. And as far as I'm concerned, that's it.
Speaking of values, the third trend out of your 5 trends that are driving this massive shift of capital into climate change solutions is evolving social norms. And you've taught thousands of students since you started teaching in, I think, 2004. I think you also have 2 children in their 20s.
Yep.
And I'm wondering what you see in terms of evolving attitudes and norms and how this is actually having a very practical impact on corporations and their behavior.
So there's been a big evolution in norms, particularly among younger people. And I think a lot of that is recognition that climate change is real, back to the physical manifestation, and recognizing that their generation is really going to have to deal with this for better or worse. And, I've had an anecdotal experience through teaching, from teaching smaller classes in this area to this year, we're here at Columbia Business School, which, by the way, is a pretty traditional business school, right? One of our many claims to fame is value investing. And, this is far from a radical liberal business school. We're very, very mainstream. We're a very large business school. We introduced a new business and climate change course this year, and we'll probably have half the class take the course this year, and we would have even more if I could just find more professors to teach it. I mean, it's massively oversubscribed, and that's not because students say, "Oh, I have to take this because it's a morally right thing to do." It's because they see the world as it is and where it's headed, and they realize this can be a really important thing for them personally and for their careers and their businesses. So that's anecdotal. There's a lot of research showing a couple of things. One is that employees looking to work in companies show a marked preference to work for companies they believe are sustainable. And there are a lot of reasons for that. But at the end of the day, getting the best employees is a big competitive advantage for companies. All companies compete for really good employees. And that's a big trend. And it suggests that, that's not going to change anytime soon. Right? Employees wanting to work for sustainable companies makes companies take more action to be more sustainable because they want to get the best people. Similarly, we see that among consumers. Among consumers, you walk in a coffee shop and there's, these big things in the wall about how sustainable their coffee is and how much it's helping to address climate change and so on. And you ask yourself, why did they put that on a wall? Like, what does that have to do with the taste of my coffee? And the answer is because consumers like it. They prefer it. Now, the evidence is consumers are generally not willing to pay much more for it. Only a small number of consumers are really, really willing to pay up for sustainability or climate change. But most businesses sell a product that's kind of, is kind of fungible, kind of commoditized. Coffee. Good. There's a lot of good coffee out there, and so you see companies more and more competing on sustainability attributes because it's what the consumers want, what the customer wants, and so again, that's driving more investment and more change at the business level. And then you got investors themselves, right? And then we've had this increasing, almost a wall of capital looking to invest in companies that do well in these issues. And part of that's the whole ESG movement, which is another whole issue. Happy to dive into with you.
We'll definitely get to that. It's an important issue. and again with a lot of misinformation.
Yeah, a lot of misinformation there. Oh my gosh.
Let's come back to that. But I think this question of how this shift in social norms is changing the behavior of companies is really interesting. We've seen a lot of these businesses, very prominent businesses, make really ambitious pledges that they're going to reach net zero in terms of their emissions. I think Apple said it would get to net zero by 2030, Verizon by 2040, American Airlines by 2050. Then you've seen companies like Ford and Starbucks and the like. And then you mentioned that Microsoft, I think, committed to removing all of the carbon it's emitted since it was founded back in 1975. And so I'm curious how these pledges actually help their competitive position, and to what extent it's greenwashing, and to what extent it's really sincere, and to what extent it's even at all measurable, given that everybody defines these things very differently and that it's all voluntary. Like it sounds like a really great way to kind of claim that you're righteous while not actually doing that much.
That's right. That's right. So I taught a whole course on this, a whole class on this yesterday. It was pretty interesting 3-hour discussion with my business school students. And all the issues you raise are correctly. So in other words, you've got a lot of companies making these pledges. Why are they making these pledges? Because they're feeling pressure to do so in various ways from their various, we're called stakeholders and employees or consumers and anything else. It seems to be, it's just kind of a smart strategic business decision. Some of them, in doing so, have a pretty clear plan on how they're going to decarbonize. Generally speaking, because they're in an industry where it's not so difficult to do it. So, you look at a Meta or an Apple or companies like this, most of their emissions are from electricity use. And the way to solve that is to invest in renewables. In fact, they're even investing in 24/7 renewables. So they're figuring out how to get power 24 hours a day. And first of all, they know how to decarbonize. There's a clear path to doing so. And these are very, very profitable, wealthy companies. So they have the capital to do this, right? For them, it's pretty straightforward. Then you've got other companies, airlines, American Airlines, and so on, which are making these pledges. I'm going to go on the assumption that they want to make the pledge, but there is no clear path for them to do so at this point in a way that's clearly going to reduce emissions. I mean, there are sort of workarounds using things like carbon credits, but those are a whole raft of issues as to whether or not those are actually effective and so on. And then there's companies, all the companies in between, that are doing various amounts of greenwashing, use that term. And it's rampant because, there's no regulation around these net zero pledges. If you make a promise and it's prolonged in the future and you don't meet it, there's really no penalty. And there's, it's just such a incentive to, at the very least, exaggerate what you plan to do and in the worst, lie. So there's a lot of that going on. And I also think there's a certain amount of accidental greenwashing. What I mean by that is companies, they have a plan, but there's a lot of uncertainty about how to decarbonize certain industries, things like steel and cement. These are very complex to actually decarbonize. So they have a plan, and they get out there and they start working on that plan, and they realize they made assumptions that weren't correct. And that's not because they're foolish. It's because there's a lot of complexity to these technologies and this innovation. And then they get out there and they realize the plan isn't going to work the way they thought it was going to work. And so they've made a pledge. Now, is that greenwashing, or they're trying to do the right thing and it's just not working out the way they'd hoped? So you got a lot of that. I think a lot of that's going on as well. For some companies, this turns out to be harder than they realized, or more complex. So I think what's going on with companies are doing it because of all the pressure they're seeing. Also, in certain parts of the world, like Europe, there's a real regulatory pressure as well. And I think it's fantastic these companies are coming out with net zero pledges. Why? Not because I believe they're all going to make their pledges, not because there isn't a lot of problems with them, but because it's forcing them to, at the very least, try to understand what's going on in their business to reduce emissions, and at the best, actually take action that works to reduce their emissions. And there's a lot of examples in companies that have reduced emissions, truly reduced emissions pretty quickly. And, at the end of the day, climate change emissions are mostly a result of business activity. Businesses emit most of the emissions, and more importantly, businesses have the solutions to change it. Us as consumers, we can change our behavior a little bit. I can bike a little more. I'm a big bike here in New York City, but that's not going to make a difference. What's going to make a difference is companies coming up with products and changing their business methods, their supply chains, doing things that reduce emissions. And so if a net zero pledge is what gets a company to really work on that and talk about it and report on it, I think that's absolutely fantastic. That's just what we need.
There's clearly much more focus on analyzing factors like environmental performance, social performance, governance issues, ESG as it's known. And I know you've been very involved in this movement. I know for one thing, you chair, I think, Columbia University's advisory committee on socially responsible investing. So you're right there in the weeds, advising the university trustees on these ethical and social issues. And I know that Columbia, the climate school where you work, has partnered with Alliance Bernstein to try to figure out how to integrate climate risks in investment analysis. And I'm wondering in practical terms, beyond the noise and political bluster about ESG, what you find in terms of the benefits of actually incorporating these sort of considerations when you're analyzing a company. I mean, when you're looking at a business and you're actually deciding how resilient are the cash flows here, it seems to me pretty smart to be considering environmental issues, like way beyond the political issues involved. It just seems pragmatic.
It's pragmatic. So what's going on in ESG today is both fascinating because it's so bizarre, and also a little depressing because it's so misunderstood. So let's first again step back. What is ESG? ESG is simple. It's a very simple concept. So simple it shouldn't really get much attention, which is if you're an investor and you're considering making an investment, you're going to presumably do a certain amount of analysis. You're going to, review the financials of whatever that asset is, a stock or a building. You're going to look at the quality of the management. You're going to look at competition. You're going to look at, growth trends, all that stuff. All ESG is, it says, in addition to that analysis, you should also consider what environmental factors are going to affect that asset value, what social factors might affect that asset value, and what governance issues affect that asset value. That's all. It just do a little more analysis, do a little more work. And that's smart because in the world we're in today, the modern economy we're in today, those factors can really affect asset values. 50 years ago, most shares traded based on book value, the actual physical value of the assets. You just start added up, all the buildings and everything. That's what the company's worth. The amount of cash in the bank. Today, most companies, the value is in intangibles. If you look at, say, the S&P 500 or something like that. And ESG factors can really affect intangibles. They can really affect brand value. They can really affect risk to businesses and the like. And so it's kind of a smart idea. Or to put it in like really simplistic terms, if I'm going to buy a home, let's say a second home, a vacation home, and let's say it's a place that's perhaps exposed to potential flooding, I should probably, while I'm checking out the house, go down, open the door, go down the basement. And does it ever flood down here? How often does it flood? How bad's the flooding? Is it going to flood more in the future? Is there a sump pump to reduce my risk? I'd be a fool not to check out the basement. And that's kind of what the concept of ESG is. Now, here's where it gets, misunderstood and a little bizarre. The idea of ESG has also been taken up by those who care about climate change and other issues to say ESG is a way of helping us solve climate change because the whole concept is to move capital into companies who are going to address climate change. And that's not what it is. And so there's this idea that ESG somehow is going to put all that capital where it needs to go. That's not ESG. And so there's a lot of people sort of on that side of the argument saying the problem with ESG is people aren't doing enough of it. They need to do it better and harder. Well, that just misunderstands what ESG is all about. And then there's another group who are saying, the problem with ESG is it's taking money away from fossil fuels and it's hurting the economy. And that's not true either. It's really just the market. It's the investors trying to be a little bit smarter, recognizing that the world we're in is more complex than the world as it was, because these factors really matter. They matter to business, they matter to the economy, they matter to society. And in the future, they're going to matter even more. Politically, it's now been politicized completely. And at this point, I think it's, it wouldn't bother me if I never heard the letters ES and G ever again.
I thought it was very interesting. I watched Larry Fink on CNBC back in 2020. I was rewatching it yesterday, and he's become a kind of punching bag for people who are very political about this.
He doesn't want to hear the letters ES and G ever again, too.
No, exactly. And, for people who don't know, he's the CEO of BlackRock, which is the biggest asset manager in the world, and has made a huge move into this area. And he just said, climate risk is investment risk. And that seems to me just so obviously true, that if you want to cut through the nonsense, you want to actually be saying, you want to include these factors. And then more outrageously, but very thought-provokingly, I saw a colleague of yours at Columbia, Shiva Rajgopal,
sure. Yes.
Who wrote this very interesting analysis for Forbes about the negative social impact of Coca-Cola in terms of things like water use to produce sugar and carbon emissions, and the generation of unproductive waste from things like unrecycled plastic bottles and the like, I guess. Not to mention diabetes cases caused by sugary drinks. And Shiva's argument was that actually the social costs are greater than what was then, I think, the $235 billion market cap of Coca-Cola. And I just thought that was a really interesting line of argument, where you're starting to see people say, this company is much more vulnerable because it's not doing good to mankind. What do you think? What's your reaction to that?
Well, exactly. That's exactly right. Shiva's analysis in his articles is a little bit, he's pushing a point pretty hard, and that's his style. And I like working with Shiva. But I think fundamentally, I completely agree. And that's kind of what ESG comes down to, is what are the risks to the business because of these other factors that historically have not been priced in, and maybe will never be priced in. Maybe, Coca-Cola and companies that make these sugary drinks will never care for the fact that really the health bill that's associated with them is outrageous. But it's a pretty good argument to say at some point, the chickens are going to come home to roost, so to speak. We should care about that. And one day that's going to affect that business. Now, if you think it's going to be decades in the future, you may say you're right, but it doesn't matter to an investment perspective, because anything decades in the future does not affect really the value of an asset much today. It may be real estate. And that's where we come back to climate change, because up until pretty recently, everything was too far in the future. Mark Carney, when he was governor of the Bank of England, he made a famous speech where he talked about what he called the tragedy of the horizon. And what that is, a play on the words tragedy of the commons, which is to describe the climate change problem. But tragedy of the horizon was climate change was felt so far in the future at that point. But even if you were an investor, even if you're Larry Fink and go, look, this stuff is real or serious, and we got to think about it and incorporate it into our analysis, you did the math, and it was so far away that it doesn't really affect asset values today. So you go, not much to worry about. Well, that tragedy of the horizon, that horizon's now much closer. And we're now starting to see it affect asset values, and we're starting to see how that risk is becoming real. And to your point, the quote from Larry Fink, climate risk is investor risk. And now those numbers are starting to show up.
Yeah, it was interesting to me. I went to London recently to speak at a BlackRock event about real estate. And one of the top people at BlackRock, their global strategist, was talking about the 4 mega forces that drive a lot of their investments, and one of them was decarbonization. So it's a huge driver of what they're doing. But one of their money managers sort of mentioned in passing, he was like, well, for the first time, you could actually see a property losing all of its value because you failed to take into account these factors.
That's possible. Now, just to be clear, sometimes get people say to me, well, climate change, it's going to wipe out all these values, and I would never touch this sector or that sector, and so on. And that's not true either. We do have to put everything in the context of materiality. And so for some businesses, these factors aren't that material at the moment. We talked about Apple before. Apple's not terribly exposed to climate change, and they can afford to decarbonize. Other companies are very exposed. And so we do need to, make sure we understand the materiality of the problem, both today and in the future for different businesses. It's not all the same.
And things can be great investments just because they're so cheap. So I have a couple of friends who are well-known hedge fund managers who've been looking at coal stocks because they're like, yeah, I can get them at 1 times earnings, 2 times earnings, or whatever it is, like incredibly cheap.
Totally agree. If the asset value is really low or it's modest, but in the next several years, it's not going to make that much difference. Obviously, it also depends what kind of an investor you are. If you're a day trader, it's irrelevant,
Yeah.
right? If you're, a typical, say, fund manager, a couple of year horizon, it starts to become relevant. And if you're someone who's sort of planning your retirement or a pension fund, probably these factors are very relevant. And so timing is a big deal here.
So this does get at this general topic that I want to explore with you of how to invest in this arena, because there are some tremendous opportunities, clearly. And you mention in your book that there are various different types of funds that you can use to play this stuff. So there are fossil fuel free funds, right? I think State Street launched a very popular ETF that tracks an S&P fossil fuel free index. So that's a kind of divestment approach where people can just say, yeah, I'm not going to invest in coal and crude oil and natural gas and shale gas and the like. Then there are these thematic funds where you're looking for a few really powerful trends, whether it's electric cars or renewables, climate solution funds, I guess you would call them.
Right.
What's an investor to do? For our listeners, regular investors. I mean, we have clearly lots of our listeners are also very, very sophisticated professional investors, but lots of us are not, and we don't have access to venture capital funds and private equity funds. What do you do to position yourself so that you're not going to get crushed by legacy assets that suddenly become stranded, but you're also positioning yourself to benefit over the next 10, 15, 20 years as this major shift towards low carbon happens?
Yeah. So let me first preface by saying that, when it comes to predicting climate change, impacting the economy, decarbonization, things like, the transition from fossil fuels to renewables, honestly, it's not too hard to do. I don't want to downplay my job, but it's not that hard a job. Picking investments, beating the market, this is hard to do. Let me, that's the absolute. So I want people to think, well, obviously, this is easy stuff. It's challenging. What I would say is, I would look at this sort of in three different ways. The first is for the investor who says, look, I'm concerned about this. I'm thinking long term. I'd like to minimize my risk. And also in mind feeling that I'm, kind of avoiding stuff that's going in the wrong direction over a long period of time. And that's where we get into a little more of sort of a divestment or ESG strategy. And there are plenty of ETFs or funds that do that. What I would say to an investor is, don't get wrapped up in some sort of marketing pitch about how this fund is clearly going to outperform the market. A lot of ESG marketing is how we're going to, this is wonderfully going to beat the market because of ESG, or get wrapped up in you're going to change the world through this. Neither of those is by and large correct. But there's a lot of evidence, research that shows that you can very easily reduce your exposure to companies that are very high in pollution or very exposed to climate risks, and still get complete market exposure. So whether it's S&P 500 or a broader, all world index and the like. And I'm not going to pick a particular ETF to suggest, but there are a bunch of them out there. You mentioned the State Street, fossil fuel free. It's the S&P 500, and it is tracked the S&P 500 broad index almost exactly, but there's no fossil fuels in there. So over time, as you start to move away from fossil fuels, that index should protect you a little bit. So that's one group.
But it may not perform well because it may be that fossil fuel investments are so incredibly cheap that actually that's exactly what you. This just
it could be. It could be. Yeah, but most of these, the way that most of these alternative index funds are structured is to perform the market, and not underperform. So what they're doing is they're picking stocks that have very similar betas to the fossil fuel stocks, similar performance characteristics, but less exposure to emissions. That's what they're doing. And I think some of them are pretty cleverly structured. Now, there's no guarantee that they're going to eventually outperform, but I think there is some good cushioning there. I do believe there's risk protection to climate change.
You might just feel better morally doing it. So I was looking last night at this BlackRock ETF that you mentioned somewhere, which is the BlackRock US Carbon Transition Ready ETF, which I think was the biggest launch in the ETF industry's 3-decade history. It raised over $1 billion instantly. It was launched in 2021. And I was just looking, that has a lot of companies that are judged based on their, what they call sustainability characteristics. And I was just looking at their top holdings. They're things like Apple and Microsoft and Amazon and Nvidia and Alphabet and Tesla and Meta. So some pretty expensive stocks. But at the same time, you are avoiding fossil fuels and companies that consume lots of water and generate toxic emissions and stuff. And so it may be that some of our listeners are like, well, yeah, I think I may be overloading my portfolio with expensive tech stocks, but on the other hand, I'm kind of happy in the long run. And
first of all, you might be happy anyway, given the way things have gone. But more importantly, if you sort of look at the entire, first of all, if you look at just the stock market, you're highly exposed to these, these tech stocks, these really expensive tech stocks, right? That's just the market that we're in today. So if you want to exposure to that, you gotta, invest in a different market, frankly, or really, pick carefully. What they're doing is they're not saying, well, in the broad market index, you're getting this, and now these ETFs are you only, exposed to half the market or really different exposure. They look an awful lot like the market. They just very, very carefully picked out the most polluting companies essentially and replaced them with similar beta companies. So it looks and acts a lot like the market. They really do. And I'm much with those. I'm not concerned that, geez, you're going to have some sort of terrible underperformance. Maybe a few basis points up, a few basis points down. I think they're pretty solid. What you're not going to get also is great outperformance. It's going to perform roughly the market. And secondly, you're not changing the world by doing this. You're just protecting yourself a little bit. You're going to feel a little better, I think, about what you're doing in your investing. The second strategy is the one you touched on a few minutes ago, thematic strategy. So this is where you're like, I see where the world's headed. And I want to put some capital work in climate solutions, stuff that really is changing the world. And by the way, if I'm good at it, I might outperform the market, because if the world's going to change that way, I'm going to pick some of the future winners, right? I'm going to figure out which companies are heading the right way. I'm going to put money into them, and they're going to do really well. This is what we call thematic. So you could you could buy an ETF that buys clean energy stocks. That's all they do. Or you can buy, specific company stocks. If you invested obviously in Tesla years ago, you would have done very well. You could also invest in a company that's much less well known, like NextEra. It was a small, boring utility. It's now the most valuable utility in America. It's also the biggest owner of renewable assets in America, and that's what started funding its growth. So it's different ways to go. Now, the thing about thematic investing is it's greater risk, right? In this case, you're making a more concentrated bets on specific sectors of the market or specific companies, and with that concentration comes, much greater risk and much greater potential to outperform or underperform the market. I would also say that this is where you also have impact, though. So if you're comfortable with the risk and you feel comfortable making those decisions, that capital is what's changing the world. It's that capital that's backing companies that are going out and actually decarbonizing the economy. And so from a alignment of both, trying to be a good investor and feeling your impact in climate change, this is where, you're really going to have that nice alignment there. So that's the second strategy. The third strategy, I was going to mention it, though it probably doesn't apply to too many folks, but I think it's just worth mentioning. We call this impact first. So it's a strategy mostly only for high net worth or ultra high net worth individuals. And this is putting capital to work into climate solutions, companies, products, often in venture capital world, that are extremely high risk, extremely long term. They may never be commercial successes, but if they are, these might be next $1 trillion companies, so to speak. And the reason we call this impact first is that these investments are what could really move the needle on climate change. Things like you mentioned green hydrogen earlier in our talk, right? Green hydrogen is a very complex, very risky area to put capital to work, but it could turn out to be, this might be the next oil and gas industry, it's green hydrogen industry. By the way, a lot of oil and gas companies are pretty interested for that reason. It's pretty hard to know where to bet. And the reality is most of those investments, the risk-adjusted return is not acceptable. The time frame's too long. Most fiduciaries cannot put capital into impact first type investments. So I put that as a special category, but for those investors who have the luxury of maybe being able to take on additional risk or think multi-decadal in terms of their returns, that's a strategy they might want to consider as well.
It's also a fascinating area of the market because you mentioned, I think, in your book that Bill Gates back in 2016 founded a fund called Breakthrough Energy Ventures, and the investors included people like Jeff Bezos, Michael Bloomberg, Ray Dalio, and a dozen or so other billionaires. So there's something really interesting about these ultra sophisticated people who are sort of philanthro-capitalists, right? They're backing these big bets. I mean, I wasn't Gates betting on nuclear energy, and then they were doing very cutting edge solar power and energy storage technology and clean fertilizers and the like. So it gives you a sense that, in a way, it kind of validates your case that there is a tremendous opportunity both to make money in this area and to have a profound impact on the world.
That's right. Now, I do want to caveat by saying, Bill Gates put $1 billion in the breakthrough initially. I think he's put more into that. Partly because he can, right? Most of us cannot put $1 billion into investments that may never return a penny. But I suspect some of those investments are going to do very, very well. And that's what impact first investing is all about.
And it also speaks to the fact that this is an area where you want to be long-term. And
you have to be ultra long-term, ultra comfortable with risk. You have to have very sophisticated resources, whether you're self-expertise or more often, access to expertise to evaluate. You mentioned nuclear. Bill Gates is a big investor in what's called SMR nuclear, small modular reactors. Very interesting new technologies coming into the nuclear space. But there's not just one type of SMR. There are many different types, and each one has tremendous complexity around it. How do you evaluate which of these makes sense? And then most of this stuff, as I mentioned, is venture investing. It's private. So first of all, you need access, but even if you have access, being able to judge these investments is very, very challenging. But I do think it's important. I think it's important to mention it, first of all, if people understand what it's all about. And secondly, because, these investments can really move the needle. So they are important.
I'm curious about your own investment strategy, because I know that you've made a lot of investments in early stage companies. You also ran a couple of businesses that were bought out, one I think by JP Morgan. And so you've done a lot of business in this field of reducing carbon emissions in many different countries. And so I'm curious how you've solved this puzzle yourself of thinking about how to invest in a vaguely intelligent manner in the area that you're luring us all into.
Yeah, exactly. Don't keep me alluring. I'm just trying to put us some information. Look, first of all, I'll say most of my investing in this space has been early stage investing. So it's a venture, a business startup. I started some companies, and that's always highly risky, right? No matter what you do. And some investments worked out very well, and some certainly have not. Here's what I've learned, a couple of generalizations I do think they've helped me and may help others. One is to be very wary of policy support. So many of these industries start with government policy, or they accelerate with government policy. And there's a good reason for that, because without the policy, they would get started. And by the way, that's not unique to climate change. Look at many tech industries, there's often some government initiative behind it. And that's really important. But there has to be clarity on how that business or that technology continues to be commercially successful when the government policy goes away. You can't rely on government policy for too long, because it'll change and often disappear, and politically things change rapidly. So betting on politics, especially betting on political decisions that are yet to be made, like betting on government. If the government's going to put a price on carbon, the government's going to. No, they may or may not, but don't make an investment based on assumption about policy. The second thing is be careful making any investment around assumptions around changing consumer behavior. Consumers just don't change that easily. None of us do. I don't. And so the best products or businesses are those that present this consumer as something that they really like, that might be a little different than what they've had in the past, but doesn't entirely change the way they do things. I think about the Nest thermostat. I don't know if you remember that thermostat that came out a decade ago. We've all had thermostats in our home for many years. And, there's these funny little devices, these sort of ugly little devices. The Nest is a very sophisticated device, but it's a thermostat. And yet it's packaged in a way that's it's more beautiful. It looks better on your wall, right? Consumers like that. They want to put something nicer looking on their wall. That's a thermostat. But embedded in it is this technology that is more efficient in how it uses electricity in your house. So those sort of products don't try to radically change consumer behavior, or you'll never get there. Those sort of things are important. And then the third and the last thing I'd say is important is, climate business is a business. Cash flows really matter. Funding cycles matter. Really strong management teams matter. That's all the prerequisite for success. The decarbonization part of it is the icing on the cake. And if the business itself, the cake isn't really, really well baked, you're making a huge mistake. Just because it's got a positive for the climate does not make it a good business. Start with find a good business that's a positive for the climate, not the other way around.
Yeah, so it's not like you can drop your emphasis on rational analysis of businesses, management, cash flows and the like.
Yeah, and it's always easy, right? Because some of these technologies are pretty exciting. I think most investors, they'd like to have impact on climate change, know they're doing the right thing. And that sounds a little bit easy to get caught up. And then management teams themselves will stir it up. I mean, some of them are, most CEOs, especially of early stage companies, they're pretty good evangelists about their business. And evangelizing about the business is great. Evangelizing about climate change and the business, it gets a little, these things get connected that can confuse people.
What about your advice for consumers? Because I know that a lot of us are wrestling with these questions of what actually has an impact and what doesn't. So I had been deciding recently whether to buy a new car because I'm not a particularly good driver, and I'm like, I don't want a 8 or 10-year-old car that doesn't have really good safety features. And so I was thinking, well, I'll just do what Tom Gaynor did. I'll just rip off his research and buy a hybrid Toyota or a Honda CR-V or something like that. And then because I was doing my research before interviewing you, I was like, well, maybe I'm an idiot. Maybe I do need to buy a Tesla that's not the super flashy one, but they have become kind of affordable with the subsidies and the like, and it is a more beautiful car. Like, how do you wrestle with these questions over what we should do as consumers, whether it's getting solar panels, buying a Tesla, what?
Yeah. So I think that number one, I'd say the advice I give is just be informed. Like this conversation we're having, there's so much misinformation out there, and it's just important to understand what's going on. Because if you understand what's going on, you'll make better decisions. And maybe the decision today is not to do something, but if you're informed, a year or 2 years from now, you'll be ready to make a different decision. The same thing I would say is that as consumers, the two big decisions you can make that do have impact today are around how you source your power, your electricity, and your automobile. Unfortunately, there's not much you can do around flying today. You can buy carbon credits, but it's probably not going to make much impact. Sourcing your power, you may not have much choice, but if you can use solar, whether that's panels on your roof or community solar, which is pretty popular here in the US, that's a good thing. It's an impactful thing to do. And again, I'm not saying you should go out there and spend more money than you would otherwise and increase your electricity bill. See if you should be able to do it at essentially no cost. Because the key here is not to get consumers to, I'm not trying to convince consumers to go out and do things that are going to hurt them financially or hurt them in the pocketbook or, make their lifestyle less enjoyable. What I'm saying is take the time and effort. And by the way, it does take time and effort to educate yourself and ideally do things that you're no worse off. And actually, you might turn out to be better off. And in the worst case, you're at least going to feel better about what you're doing. Right. So if you can get electricity from solar at the same cost, or hopefully maybe even less, you should do that. But it's going to take you a little bit of research and looking at that. And the same with EVs. Right. So if you are in the market for a new car, take the time and go drive some EVs, check them out, do your research. And maybe at the end of the day, you're like, you know what? I'm not ready for this car yet. Next go around, I'll be there. My guess is you drive a few EVs, and particularly right now, because the prices have come down a lot. You walk in the showroom, if you're going to spend just about the same dollars either way, my bet is you're going to like the car a lot. They're fun cars to drive.
Has Tesla sort of won that game? Like, you've written a lot about Tesla.
Oh, okay.
And they be bought by all the GMs and the Fords and the like, or are they just so far ahead in terms of their sophistication and the elegance of the vehicle and the like?
Yeah, such an interesting question. It's so hard to answer. I think it's shocking how Tesla has managed to maintain its lead. They've made some very smart strategic decisions over the years, and the incumbent car companies have just been so slow to really enter the market. That being said, Tesla faces two problems. One is the incumbent car companies that we're familiar with, Ford, GM, BMW, Mercedes. They are rolling out dozens and dozens of pretty attractive products, right? So I can't say if they're necessarily better or not better, but there's now serious competition that Tesla didn't have before. And the second thing for Tesla is the international car companies that have not traditionally competed quite as much. And I'm thinking about BYD, particularly Chinese companies. Now, they may not compete much in the US. They're not here in the US yet, but they might be one day. Conversely, Tesla is in China. And that's going to be tougher and tougher competition going forward. And then lastly, Tesla has they still have some upstarts like Rivian. I think at this point, we're not going to see too many more, disruptors trying to enter that. The automobile market is now way too crowded. Maybe Rivian will be the last successful one. So a lot, the game is not the one that Tesla was playing, 5-10 years ago. They've been awfully fortunate that it's such a long runway to build and protect, build a moat around their business. But it's going to be pretty brutal going forward. I think Tesla's going to continue to do well, though. They built such a good product and such a good strategy. But it's hard to know if they'll remain quite so dominant. That would be really something.
Towards the end of your book, you write, "The era of climate change is upon us. The key question, frankly, the only question that matters, is whether humanity will avoid catastrophic climate change." And I know that you're asked this question all the time by your students and others, and I'm wondering how you answer that question yourself.
Yeah. So my response is twofold. First of all, we can avoid catastrophic climate change. I mentioned at the beginning of our discussion, we have the technologies by and large, and we're bringing on the ones we need, and we have the capital, and we have the ability to do this. That doesn't mean we will avoid catastrophic climate change, because as a species, we're not very good at dealing with long-term challenges. Look at immediate challenges like COVID. We certainly didn't deal with that one too well until we finally did. And in some ways, the way COVID played out over a couple of years, in some ways, climate change, I think, is going to play out over multi-decades. In other words, we're going to do a really poor job of addressing this, because as human species, we don't cooperate well across nation states and within our countries. We're slow to invest because the uncertainty makes us nervous, and so on. There's other challenges, and the political challenges. Our politics is just very short term. And when I say we, by the way, I don't just mean American politics. All politicians, everyone on the planet, really only have one objective, which is to get power and to keep power. And whether they're in a democracy or an autocracy, it's the same strategy. And it's always short term. That's the world they inhabit. So these are all the big challenges. But I do believe we'll avoid catastrophic climate change because we are a very smart, adaptable species. And so we will eventually decarbonize the economy. We'll probably eventually have to do a lot of direct air capture, which is to pull CO2 out of the atmosphere, which will be costly and challenging to do, but we eventually will avoid a catastrophe. Much as we did with COVID. We did not do very well, but we eventually got our act together, and it still exists, but we've managed to live with it.
And I should mention the trend 4, which some of our eagle-eared listeners will be like, you never mentioned trend 4, was government action, which is that government has started to get its act together to do stuff. And I mean, I know it's very controversial and this isn't a political show, but the Inflation Reduction Act was huge. And I was listening to Al Gore in an interview with David Remnick the other day, and he said that actually the Inflation Reduction Act, which he described as really a climate bill, was, quote, the most extraordinary legislative achievement of any head of state in any country in history, which I thought was quite a claim.
That is quite a claim. Here's what I think of the Inflation Reduction and government. First of all, why is there more government policy? And it's not just the U.S. Globally, we see more policy because of the other trends, right? When you start to see physical climate change, when you start to see changing social norms and these innovations, governments doesn't react very quickly, but it sees these changes. Politicians see these changes. They see what's happening, and they eventually start doing something about it. And that's what we see happening. In the Inflation Reduction Act is an example of that. What's really important in the Inflation Reduction Act is, yes, it is addressing climate change, but it's also a economic, industrial policy bill, on a scale that we haven't seen in a long time. In other words, what it is the government saying, this is where the world's going. The U.S. can either be a leader or a follower in this. And if we follow, it's going to hurt our economy. We're going to be behind on things like electric vehicles and energy storage and the like. And it's time that we invested so that we're in front, that we're protected, that our nascent industries are protected, so they have time to grow and to get to scale. That if people do build these businesses and they're selling products in the U.S., that they use U.S. manufacturing and U.S. labor and the like. It's very protectionist policy based on the idea that this is the way the world's going. And so either we can get ahead of it or not. And when it was first passed, of course, those who care about climate change, like myself, are obviously very, very pleased to see it from a climate perspective. Also pleased to see it from the economic perspective, because I'm American. And we also assumed that the Europeans and others would also be thrilled to see it, because finally the U.S. is stepping up to take, real leadership on climate. And of course, there was a moment of happiness, and then they kind of freaked out, because what they realized is this is economic policy. This is competitive. This is how the U.S. is going to, accelerate its competitive positioning versus the rest of the world. And so the Europeans are now trying to, implement a similar bill of their own, or something in the EU Parliament that looks a little bit similar. And of course, China also is trying to understand how they continue to compete. And this is the world that we're in, the world we're going to be in the future. So I think it's a tremendous piece of legislation, not just because of the climate piece, but because it's basically, this is the way we're headed. Now, does that mean, government policy is tricky when it comes to economic policy, because you can make a lot of mistakes and back industries that are wrong ones, and money gets wasted. The other thing I like about the policy is they're not picking a winner in there. There's support for virtually any technology, any industry that's part of these changes that are coming. And they're kind of spreading it around. And I'm like, that's the right strategy, because we don't know exactly what's going to dominate. Maybe it'll be small nuclear in the future. Maybe it'll be direct air capture. Maybe it'll be green hydrogen. Maybe it'll be just wind and solar is going to continue to be our main thing. There's support for all of that. And I think in a very clever design. So, Al Gore's statements maybe a little bit hyperbolic, but I agree with the sentiment, for sure.
I wanted to ask you one last thing, because I'm aware that you've got to run and you've been very generous with your time. There's so much confusion around environmental issues and the policy issues it brings up, and so much prejudice, so much bias, and it's very hard for people to think clearly about these topics. And they're hugely important. They'll affect all of us, and yet we really struggle to think impartially or rationally about this stuff. And you're a great educator, and I'm wondering if you have any advice for us on actually how to think better about this stuff, because I mean, you quote in the book the Harvard psychology professor Daniel Gilbert saying we're not very good at dealing with we're very good at dealing with clear and present danger, but not with future stuff. And you quote Danny Kahneman saying, yeah, we're terrible at dealing with uncertainty, and there's so much uncertainty. What have you learned about how actually, despite all of the glitches in our wiring, we can overcome our biases and stupidity and actually think clearly about this hugely important issue?
Yeah. So I focused on climate change at the business school here. This is where I work, because ultimately it's a business issue as opposed to some other environmental issues. And I think it's important to sort of separate those a little bit. So there's a number of environmental issues that people care about greatly, and I understand why. Maybe things like, for example, wildlife protection, right? And, should we have regulations to protect certain species, and how strong should those be? Are you allowed to build things like that? I get all that, but that's a really different issue. That's really much more sort of an ethical issue, an environmental issue. What do we care about, and how do we deal with that? Climate change is different. Climate change, at the end of the day, it's an economic problem. It's about how do we produce goods and resources and services without this unfortunate byproduct, these greenhouse gas emissions that come with it. And so if you look at it through an economic or business or sort of financial lens, and start to do the math and think about the numbers and so on, a couple of things come to light. First of all, you start to make it much more objective than emotional. And I think that's really important. Secondly, you start to understand what the problem is. You can frame the problem. You can also start to frame and understand the solutions. What's going to cost us? How do we reduce those costs? How do we deal with it? And I think moving it from sort of the environmental realm and sort of the emotional subjectivity of it to the more objectivity of business. First of all, I just think that's much more practical to address the problem. But I also think it gets better outcomes, because this is the crazy thing about climate change. And so the last point I'll make is it shouldn't be a political issue. We shouldn't be debating about this. There's really very little to debate about. It's very clear what's going on. I use the example of, it's physics, like gravity. We don't debate gravity. We do debate, maybe how we prioritize how to address it. I get that. People say, look, we can't spend so much money on X now because we need more on Y because, we got some short-term challenges. Those are worthwhile debates to have. That makes sense. Prioritization issues. But as to whether or not we should care or not care, is this real or not real? That's a waste of time. And the biggest problem we have here is time. If we just get on it, we're going to be in good shape. If we keep having these ridiculous political and emotional debates and talk about the environment as opposed to talk about the economy for another decade or two, then we'll really find ourselves in a bad spot.
Bruce, thank you so much. This has been tremendously clarifying. I feel much better equipped, at least to start understanding these issues and hopefully align myself over the next 20 years with these inexorable forces.
Terrific. Well, I look forward to more conversations in the 20 years to come, and really enjoyed this talk. It's terrific. Thank you.
Me too. It's been great fun. Thanks so much. Take care.
The way I have minimized the chance of selling great compounding machines too early is to have a fair number of positions. So I'm very concentrated with respect to how most people would think about the portfolio, but I'm also pretty diversified with respect to some other managers. So we have about 21 holdings today. If I had all of my money in one stock, it's going to be a lot harder to not interrupt the compounding process than it would be if you had 21 companies.